Welcome back to the Investor Minded Framework. In this video, we're talking about getting pre-approved for the financing when it comes to investing in real estate. So we have a couple different topics we're going to cover. They'll be somewhat brief because I myself am not a lender, but I want to encourage you to have these conversations with your lender about what different loan options you may qualify for. So the first one we have is conventional lending. We have FHA lending, VA lending, and then also some investment approaches such as house hacking, utilizing an investment loan or also a commercial loan, and then also considering local banks versus national lenders. So the first one being a conventional loan, which is generally going to be a 5 to 20% down payment on a property, usually for 1 to 4 unit residential. Now, it may depend on the property, and I would recommend having that conversation with your lender before maybe even putting in an offer on the property, I would hope, just to make sure you fully understand that property. That 5% down is something that is somewhat more recent and something that I've been able to take advantage of investing in real estate in my local market. It used to be that FHA was the lowest down payment option that you had, and it's not the case anymore. So using that 5% down can be beneficial because you save more capital you can use for investment in capital expenditures and maintenance on the property and just getting things afloat. The higher the down payment that you have, I would say the benefit is you have a reduced monthly payment over time. It also gets you closer to having PMI or private mortgage insurance drop off. So, private mortgage insurance, while we hadn't really discussed it, it is an extra expense you're going to have to pay every single month, essentially insuring the lender against your default to make sure that if you were to default on paying for the property, that lender is still able to get paid or at least recoup some of the cost of the non-payment. What that leads into is the FHA lending and one of the downsides of FHA lending. So we talked in a previous video about how generally a 650 credit score is what's needed to qualify for FHA lending. I would recommend looking into that to ensure that is still the case. Now, it used to be that I would consider a 20% down or a 15% down conventional loan in comparison to a 3.5% down FHA, because putting down 3.5% is a lot less than having to bring forward 15% or 20%. Well, after the market during COVID, we ended up with another lending option, which was the 5% down conventional loan. And that was something I was able to utilize to compare against an FHA. I was able to put a lot less money down to buy a property and not have to worry about refinancing to get out of PMI. That is one of the downsides of the FHA loan. PMI stays with FHA loans for the life of the loan. If you'd like to not pay PMI, you have to refinance. And the downside with that is the uncertainty of interest rates. While I would like to be able to decide what interest rates are, that would make real estate a lot less valuable. Interest rates can actually be a benefit, knowing that they cause competition in the market and can either make or break a deal. So that is one of the reasons why I strongly stick to conventional lending when it comes to any kind of traditional lending utilizing a lender. FHA loans, while they used to be one of the biggest benefits, that's not quite the case anymore. Then one of the things we want to get into is a VA loan. So with a VA loan, in the simplest terms, it's like having a trusted adult co-sign for you, but instead of a person, it's actually the US government. So the government ends up telling the bank, if this veteran can't repay the loan, we'll cover part of the loss. Because the bank takes less risk, it offers much better terms. So we'll talk about what makes a VA loan special. Is you can actually buy a property with 0% down. So instead of needing $40,000 down on a $200,000 home, you can often buy it with no down payment. And this also can allow a lot of veterans to buy their home much sooner. No private mortgage insurance is also a huge benefit. So that PMI that we just talked about, that extra expense, maybe even $150 a month that you'd have to pay on top of the loan, is something you wouldn't have to worry about. Most conventional loans require PMI if you put less than 20% down. Well, say we have a mortgage of $300,000 and PMI is $150, like we said, over 5 years, that's going to total to $9,000. Being able to qualify for a VA loan essentially saves you $9,000 over 5 years that you would have had to pay. Another option too is the competitive interest rates that come along with that VA loan. So because the lender has the government guarantee here in the US, VA loans often have interest rates that are lower than comparable conventional loans. Even a small reduction in the interest rate can save thousands over the life of the loan, which is why we talked about While I wish I could affect interest rates, there is a lot of value to interest rates still creating competition in the market. And then also easier qualification. So compared to many conventional loans, VA loans are often more forgiving about credit and debt to income ratios, although lenders still have to do their own underwriting standards. So I would highly recommend having that conversation with a lender. Do I qualify for this? Because there is actually a catch. When it comes to that PMI we discussed, a lot of borrowers may still pay a VA funding fee. And that is just a fee that they may not actually have to pay up front. It may be able to be looped into the actual cost of the loan, but that is something to definitely discuss with your lender as well. Any kind of fees that are associated with any kind of lending is something you should definitely try to understand to the best of your ability before even getting into a transaction process. So we'll talk about who can qualify for that. It's generally going to be veterans, active duty service members, many National Guard and Reserve members, and then even some surviving spouses. I would definitely recommend getting in touch with your lender, though, to understand whether or not you do qualify. When it comes to investment properties, you may not be able to use a VA loan directly for an investment property. It is intended for a primary residence, one that you live in. But that's when we get into the house hacking and what is so advantageous about it. You can take a deal that wouldn't have made any sense when it comes to conventional lending or FHA lending and have it make sense because of how little down you have to invest in that real estate. It could even be free real estate at that point that pays you to live there. And that's something you may not have when it comes to buying a single family residence that you're just going to be living in. You don't have that income aspect to it. So that is a really amazing option to have if you do qualify for it. I'd highly recommend speaking with your lender about it. Investment loans or commercial loans is something that can require a much higher down payment. And that's when we get into the category oftentimes of a greater than 4 units investment property. Many lenders, every lender I've spoken with has required at least 20%, I believe 25% down oftentimes for those commercial grade loans. Something greater than 5 units or 5 units or above. Oftentimes, any eightplexes, sixplexes, those even number units, sometimes fiveplexes that you look at are going to have that requirement of a down payment. So, really just consider what property you're looking at and what lending makes sense. When shopping around for your lending, we also want to look at local banks compared to national lenders. A lot of people are in the camp of building a relationship with your local bank can be really advantageous. It can reduce the fees and also give you more favorable interest rates. And then also national lenders can sometimes be a downside because they may have a very corporate approach. Everything is the same when it comes to lending. We can't give any kind of wiggle room because it has to be the same for everything. They have a lot more red tape. So understanding whether or not a national lender makes more sense versus a local. And some of that could be as simple as just having a conversation with those lenders while you're going through your process of building your team. I have found that at least local banks aren't as favorable in my market from what I've found so far. I hope to find some because I'd love to build relationships with them. But over time so far, I just haven't found that it works in my market. My hope is that it works for you in your market when it comes to buying that property. At the end of this process, you should be able to look at all those different loans, have that conversation with your lending team, and understand that you fully know your budget. And that allows you to move forward to the next step of the process.